Now, my first guest has been sounding the alarm for months. I want to bring it down from Sykon Capital, President and CIO Todd Stankiewicz. And Todd, so let's talk about this because you wrote a piece about private equity back on November 25th last year, separating the hype from reality in a booming market. What funds companies aren't telling you. What weren't they telling us?
Well, we were hearing all the good stuff, right? We were hearing about private credit, private equity, right? Particularly private credit when we were talking about equity-like returns, a bond-like volatility. We were hearing about how we're uncorrelated to the public markets, right? We were hearing that same thing with private equity as well. And really, at the end of the day, you got to ask yourself, if this is all great, what's the trade-off?
Right.
And a lot of the trade-off had to do with liquidity.
Right. In fact, you've written about that several times, but more recently you also wrote about it. We'll share the headline with the audience. And before we even get to the liquidity part about it, one thing that I've always been concerned about is the sort of opaqueness of it all. But it didn't matter because you had to be an accredited investor.
Yep.
Well, if there are things they weren't telling us right now and the way it's been acting right now, should we rethink private equity going to 401ks?
We need to rethink that whole space going in the 401ks in general. Because at the end of the day, when we look at who's investing in 401ks, the big investors in 401ks are a retail investor. It's not always sophisticated investors.
Right.
And when they look at it, the way they pick funds sometimes is just what has the largest return.
Right.
And the returns of these funds have actually been good over the past couple of years.
The other thing we're learning here in the last week or so, particularly this trade-off that you've written about, right? The trade-off between yield, liquidity, and risk. Listen, if I have a 401k and I need my retirement money and you tell me I can't have it, I'm in trouble.
Yes, yeah, very much so, very much so. And we often see mutual funds in 401ks as well, but we have to remember back to the fact that in 2015, there was a fund, Third Avenue Focused Credit, that was an open-ended mutual fund that actually gated redemptions because they had exposure to illiquid credit assets.
Right.
And they couldn't redeem it. And a lot of people didn't realize that could happen. So even in mutual funds, that can be the case. And so for 401k investors,
then some of the headlines of Blue Owl, I'm not sure if you can get the people can get money back or not because the CEO keeps going on TV saying you can, but the headlines keep saying you can't. I want to ask you, speaking of which, so we kind of lump them all together. Today they're all taking a pretty good hit. Apollo, the biggest hit, but year to date, Apollo's down the least over the last 1 year period. Blue Owl down over 50%. Is there a name in here that you're looking at that maybe, okay, stands above the rest? Maybe it shouldn't be down as much as the others?
Yeah, when we look at these names, they're not all the same. And I think that's a great observation because the reality is, you look at Blue Owl. Blue Owl is very heavily focused on private credit, which has had some of the biggest headlines and some of the biggest liquidity right now. But some of them like Blackstone, which, full disclosure, we do own that in one of the ETFs that I run, it is more diversified. So it's not just private credit, private equity, real estate, and certain things like that. So I think if you're looking at these names, you want to find the ones that may potentially have more diversification.
Right, and Blue Owl, everyone's staying away from it for right now. Just too many question marks.
It depends. If you listen to the management, they're trying to really encourage investment there.
Yeah.
But it's risky.
I've got a minute and a half to go. Let's talk about some things that you like. Starting with Nexstar. That's an interesting idea here. I hadn't looked at this one in a couple of years.
Yep. And again, I'm a portfolio manager on an ETF, FMKT, that focuses on companies that benefit from deregulation. And Nexstar is one of the largest holdings we have in that portfolio because the FCC rolled back over 90 outdated regulations just middle last year. And Nexstar is one of the big beneficiaries of that. And they're trying to purchase Tegna Media. And that could be a major merger, which could give both of those companies massive scale that they need in the broadcast stations.
WMB Williams?
WMB, natural gas play. We need to build natural gas infrastructure. It could be an AI story, but we're looking to promote particularly the administration natural gas infrastructure build out. Williams is one of the best ones in that space right now.
They've been acting pretty good here lately too. The natural gas ideas and Citizens. So I had a guest yesterday who liked Citizens. What is it with Citizens? Why is it so popular with investment managers?
If we look at money moving away from the private credit space, they're going to have to move back to traditional banks. And I think the regional banks are probably one of the best positioned right now. And Citizens has been making a ton of changes through their private wealth management space and private bank. And they're really making some foundational changes, which I think they're in a position to be a benefactor of that over the long term.
Deregulation. I love making money off that. What's this? Give us a symbol. You went fast on that. We have some people listening on the radio.
Yeah, the ticker symbol on that is FMKT, Free Market ETF.
Free Market. Good stuff, man.
Yep.
Thank you very much.